everybody. My name is Mackenzie Patel. I'm the CEO and co-founder of HashBasis, a crypto-native accounting firm based in San Francisco and Nashville. We help businesses and individuals with their crypto accounting, crypto tax, and subledger implementation needs. Now, we started business in around February of this year, so relatively new, but it's been an absolute blast so far getting to work with all of our customers and helping them get their crypto books in order. So I hope you guys are ready for a technical accounting presentation today, because we are doing a seriously deep dive on the token roll forward schedule, which not only is a fabulous accounting tool, but it's also a great map for anyone to see at a glance what a company is doing with their crypto. So with that, a quick agenda. We're going to go into the definition and the history of the roll forward schedule. Then we'll discuss why do we need a token roll forward schedule in the first place. And then finally, we're going to do the deep dive into a roll forward, looking at it both from the perspective of the number of tokens and then translating that amount to USD. But first off, let's cover the definition of a roll forward schedule. And so it's pretty simple. You take the beginning balance of an asset, you add to it any inflows of that asset during the period, subtract any of the dispositions or outflows of the asset, and then you arrive at your ending balance. So again, it's pretty simple. Keep this formula in mind as we go on, because some of these roll forwards can get kind of crazy and complicated, but if you remember this formula, then you'll be good to go. Okay, so let's now get into the history. And I love history, so this is like my favorite slide. But this is where we started on the left-hand side. So this is a tablet from Sumeria, which is one of the ancient civilizations in Mesopotamia. And the earliest accounting and, in fact, written records were found here, and they're written in a script called cuneiform. So in case you couldn't tell, this tablet is basically depicting the ins and outs of barley, which was a really popular crop back in the day. And while this isn't exactly the modern roll forward schedule as we know it, it is showing the ins and outs of an asset, starting with the beginning balance. So let's say 0 barley, and we have all the asset movements, and you arrive at your ending balance. So let's fast forward a couple of millennia, and now we have progressed to the roll forward schedule that you see here. And so on the right-hand side, this is the iconic version of the roll forward, which is the fixed asset roll, which everybody knows and loves. And it tracks things like the fixed asset movements, so like furniture, equipment. It tracks the cost basis, so how much did you pay to originally acquire the fixed asset? You subtract out all the accumulated depreciation, and then you arrive at your net book value. So everyone's very familiar with this type of roll forward. Now, let's fast forward to what I'm calling the roll forward of the future, which is the token roll forward that you see right here. And right off the bat, you can tell there's a lot of stuff going on here. There's way more columns, because in addition to tracking the USD amount, we are also tracking the number of tokens. So we have beginning balance in tokens and USD. We have additions, dispositions, and then some other fun calculations like impairment and realized gain loss. And so this is what we're going to be diving into a lot today. But first off, I want to discuss why do we even need token roll forwards in the first place? You know, they're not only great for accountants, we love them, but they're also useful for the public as well. So just a couple reasons. The first one is that they let you really easily tie out on-chain token balances to your books. Because the rule of thumb is that whatever is showing in your book should, equal out to the crypto that you have in your wallet. And so I like to describe it in terms of sort of a newfangled three-way match. The token roll forward should match your books, should match what is happening on-chain. That's just what needs to happen. And the roll forward just makes it really easy to say, hey, I have 10 ETH at the end of the period. Do I actually have that in my wallets? You can also track some other things like cost basis, fair market value by asset, realized gain losses, and under the new rules, the unrealized gains and losses. So that's more so on the accounting side, but it's also useful for other people as well, especially for investors and the public. Because again, the roll forward is a really great snapshot, so you can see exactly what a company is doing with their crypto. How is it coming in? How are they offering it? Where is it going? So very transparent. The roll forward is requested, and actually I should change that to required by auditors, and they're going to want to see support for the ending balances and beginning balances that you're showing on the roll forward too. And finally, as we just discussed in the last panel, this roll forward is going to be required under the new FASB rules. So let's take a deeper look into that. And so this is actually an excerpt from the FASB exposure draft that came out a couple of months ago. And the roll forward is part of their new and enhanced disclosure package. And the new rules are meant to provide transparency. The FASB wants to know all sorts of things about your digital assets aggregated in this roll forward. They want to see your balances, beginning and ending balances, additions split by category, in addition to dispositions split by category, and your realized gains losses. So that's what we have right now, but I did want to also have some news fresh hot off the press, which was also recently discussed, but there was a FASB board meeting earlier this month, and they spent like 20, 30 minutes talking about the roll forward. It was very fascinating. If you have 2 hours to kill, definitely recommend watching that board meeting. But there is a slight difference as it pertains to roll forwards between what was in the exposure draft and what the new ASU will likely have. And so in this meeting, they said, if you earn crypto as part of non-cash consideration in the ordinary course of your business, and then you immediately convert that crypto to cash, you can exclude that from your roll forward, which I just found to be really fascinating. And I'm also very curious to see how the crypto subledgers are going to sort of implement this new rule or exception. Because it's kind of specific, right? And it could be subjective as well. That was supposed to be a screenshot of the FASB meeting, but that's okay. All right, so now let's dive into an actual real-life example of a roll forward. And this is a report straight out of Cryptio. It's called the Detailed Asset Roll, which I really love. And this actually is a real roll forward. So I do part-time accounting for a DAO called DORG, and this is the numbers from there. And what I really love about Cryptio is that you can basically label or affix a label to each transaction, and then this detailed asset roll breaks down all of your activity by those specific labels. So it's exactly what the FASB is saying, where you need to break down your additions and dispositions by these labels. And that's exactly what you see here. And so now we're going to get into the different components of the token roll forward, and we're going to start with reconciling the number of tokens first. Because first off, it's just easier, but also if your number of tokens that are rolling are incorrect, then you just automatically know the translated USD balance is also going to be incorrect as well. So let's get into that. So the first two sections we're going to talk about are reconciling the beginning and the ending token balances. And so again, the rule of thumb is that what you're showing as your beginning and ending tokens should match what you actually have in your wallet. And there's a couple of different ways you can get support for this. The first one is taking a screenshot of your wallet address on a block explorer at the end of the month or at the end of the year. So you have support. Again, you can show that to auditors, for example. But you might want something a little bit more robust than that. And so if you have access to the wallet, you can log in, take a screenshot there. And even better, if you have access to a node that's running a historical copy of the blockchain and you can query a point-in-time balance, you can go ahead and do that. And so what you see here, this is just a screenshot from MintScan of the Cosmos blockchain, one of my favorite blockchains. And you can see as of when the screenshot was taken, this is the crypto that we actually had. Okay, so we pretty much knocked out two of the parts of that equation, and let's go ahead and talk about the other two. So the first one are the additions. So what is actually increasing your digital asset balance? And there's a whole slew of things. You have rewards like staking, mining, LP rewards, airdrops. If you did some services and then received income in crypto, it's going to increase your balance. Token trades, and I find that easiest to understand by looking at a journal entry. So let's say you're swapping ETH for OP tokens. You're going to debit digital assets for the fair market value of the OP, credit digital assets for the cost basis of the ETH, and then that difference is going to be a realized gain or loss. But part of that journal entry, so the debit, that's actually increasing your digital asset. So just know that's going to show up on your roll forward. If you send an invoice to a customer and then they pay you in crypto, that's also going to increase your balance. Just make sure revenue is not duplicated there. NFT royalties or minting fees, and then of course if you purchase tokens with cash. So just a couple of things to consider here, especially if you're earning revenue in crypto. Make sure to look at the roll forward and say, hey, does this pass my gut check? Does this actually make sense? Or for example, if you have token trades, do all the trades in your subledger tie out to some Binance or Kraken CSV that you're able to pull? Because again, the roll forward is really just a summary or an aggregation of all of your data that's happening on chain. So it really should make sense to you. It should be familiar. Now if we head over to the disposition side, so these are things that are decreasing your digital asset balance, their outflows. Again, the first one is token trade, so it's the credit in that journal entry. Slashing penalties if you're a validator, loans, gas fees, wages or bonuses if you're paying people in crypto, paying loan interest, selling crypto for cash, etc. And just something I want to mention real quickly, so if you're staking assets on a proof-of-stake blockchain, the subledger might think that that's a disposition, but really you might just be depositing tokens into a staking contract, and you still have dominion and control over those assets, so you want them to show up still on your balance sheet and on your roll forward. So just a note on that. And just some things to consider with your dispositions. When you're looking at your roll forward, you want to ask, okay, is this company following the treasury policy that they set out? Are they off-ramping the appropriate amount of tokens? If you're a validator and you have slashing penalties, do you now have an obligation to pay missed rewards to your delegators? Or if you're paying people in crypto, like what are the tax and legal ramifications of that? So always just be looking at your roll forward, questioning it, and just making sure that it really makes sense to you. And with that, we pretty much finished the token side of it, so you can see pretty simple, but let's go ahead and switch to USD. And I know we're right before lunch, so I'm sorry for the food analogy here. But I'm going to explain why I have this ice cream cone up here, but I do recommend scanning the QR code. I'll get into a second what that is. But for this analogy, imagine we have an ice cream cone. And the base of the ice cream cone, which is the ice cream, is your cost basis, or the price when you originally acquired your crypto assets. And so your cost basis is not going to change. It is the base of the cone, just it's historical, it's real, it's going to stay that way. But now, under the new rules and also the current rules, there's different calculations that are layered on top of your cost basis. So right now we have impairment, which is artificially lowering your cost basis to the lowest price during the period which you held your crypto. So I'm calling that impairment sprinkles. But again, your cost basis stays the same, that's not changing. Now, under the new rules, we're going to have fair value. So you have your cost basis, but then you have, okay, what's the market saying our crypto is actually worth? And then that difference is your unrealized gain loss, calling that the fair value cherry. Cost basis is the same, but now your digital assets might have a different value on your books. So I created an example roll forward, both in tokens and USD, but it's pretty complicated, so that QR code actually links to a Loom video and the spreadsheet where I just go into like extreme detail on this thing. So if you're curious, definitely recommend checking that out, but we can take a look at some screenshots that I put together. So this is what a roll forward looks like under the current rules. I know there's a lot up here, so I'm just going to call out a couple of things. The first one is that we're always still tracking cost basis, right? What's the price at the time you originally acquired the crypto? But we're also tracking impairment, because that's what we have under the current rules. And so that's going to artificially lower your cost basis. And it comes to something called the carrying value, which you might have heard, which is just cost basis minus impairment. Additions tend to increase your digital asset balance at the fair market value. You have dispositions, which give rise to a realized gain loss, which is the difference of the fair market value minus your carrying value. And then if there's more impairment during the period because of price decrease, you're going to recognize additional impairment to arrive at your ending carrying value. Now I have ending fair value up here, but under the current rules, it doesn't really matter at all because you can't really write your assets back up, so can't really do anything with that. But this is what I think the roll forward will look like under the current or the new rules that we're going to have. So again, just a couple things to call out. We are still tracking our cost basis, which is the base of the ice cream cone. That is not changing. Our additions still going to be the same, fair market value. Dispositions, again, you're going to have a realized gain loss. But now that's the difference between the fair market value and the cost basis, not the carrying value. Because under the new rules, there's going to be no impairment. What we do have, though, is that the ending fair value actually means something now. And so the difference between your cost basis and the ending fair value is going to be your unrealized gain loss, which then rolls through your income statement. So the way that I envision it's going to work is I think there's going to be a line on your balance sheet called digital assets cost basis. That's the base of the ice cream cone. That's not going to change. But then there's going to be a separate account that's digital assets fair market value adjustment. And that's going to be the other side of where the unrealized gain loss is going to be booked. And then those two added together are going to be the fair market value of your digital assets on your book as of the ending reporting period. Okay, so with that, let's roll. Hopefully this is very helpful. If you have any questions, please let me know.